That's a sharp question, and it depends on what you mean by giving money to a bank. If you mean depositing your savings, here are a few reasons to think twice before just parking all your cash there. 1. Low returns on savings. Banks usually pay very little interest on deposits, often less than inflation. That means your money loses value in real terms over time if it just sits in a savings account. 2. Hidden fees and charges. Banks often charge account maintenance fees, ATM fees, overdraft fees, etc. These small leaks add up and quietly reduce your wealth. 3. Inflation erosion. If inflation is, say, 10% and your bank gives you 3% interest, you're effectively losing 7% of your money's purchasing power every year. 4. Opportunity cost. By locking up money in a low yield account, you miss out on other investment opportunities: stocks, bonds, ETFs, real estate, even your own business. 5. Risk concentration. If you keep all your wealth in one place, a single bank, you're exposed to that bank's risk. While insured deposits are usually safe up to a limit, it's not wise to be fully dependent on one institution. 6. Bank priorities, your priorities. Banks make money by lending your deposits to others at much higher rates than they pay you. Essentially, they profit more from your money than you do. That said, banks are useful for safety, better than keeping cash at home; convenience, payments, transfers, credit history building; liquidity, easy to withdraw. The smarter move is usually to keep enough cash in a bank for short term needs and emergencies, but channel your extra money into investments that actually grow your wealth. Do you want me to break down a simple plan for how much you should keep in the bank versus how much to invest? Got it. Let me rewrite the breakdown in English only, no Arabic. 1. Emergency fund in the bank. Keep 3 6 months of essential expenses: rent, food, transport, bills. Store this in a checking or savings account that's easy to access, even if the interest is low. Purpose: quick access to cash during emergencies, job loss, medical costs, unexpected expenses. 2. Short term liquidity, also in the bank or short term deposits. Money you'll need within 12 months, e.g., travel, a major purchase, moving costs. Can go into a short term deposit or a higher yield savings account. 3. Investments, outside the bank. Anything above your emergency and short term needs should be invested to grow faster than inflation. Options include stock market, individual stocks, ETFs, index funds, bonds or fixed income instruments, safer but lower returns. Starting a side business or learning a new skill that generates income. 4. Suggested split, adjustable to your risk tolerance. 20% in the bank, emergency short term needs; 80% invested for long term growth. Summary: bank equals safety, liquidity; investments, growth, wealth. Balance the two so your money doesn't lose value over time. Do you want me to run a numerical example for your exact salary, 7,000 per month, to show how much should go into each category? Perfect. Let's run the numbers with your monthly income of 7,000. As step 1, emergency fund. Aim for 3 to 6 months of expenses. Let's assume your monthly essential expenses are about 5,000, just an estimate. Emergency fund target equals 15,000 to 30,000 kept in a bank savings checking account. Step 2, short-term liquidity. Suppose you want to keep 1 to 2 months of expenses for near-term needs. That's about 5,000 to the 10,000 in short-term deposits or a savings account. Step 3, investments. Once you've set aside the above, the rest should go into investments. Example: if you've saved 50,000 total so far and you keep 20,000 in the bank, emergency plus liquidity, then about 30,000 can go into investments. Step 4, ongoing allocation from salary. 7,000 per month, 20% equals 1,400. Add to your bank savings until your emergency fund goal is fully reached. 80%, 5,600, direct into investments once emergency fund is done. This way, you're always safe if something bad happens. Your money in the bank doesn't just sit there forever. Most of your extra cash is working for you through investments. Do you want me to suggest specific investment options you could start with in Egypt right now? Stocks, funds, bonds? All right, let's look at specific investment options you could realistically access in Egypt right now, all in English. 1. One stock market, EGX Egyptian Exchange. You can buy shares of Egyptian companies directly or through a broker. Examples: large banks, telecoms, construction, or consumer goods companies. Pros: potentially high returns. Cons: higher risk, requires learning or guidance. 2. Mutual funds and ETFs through banks or asset managers. Equity funds: invest in stocks for growth. Balanced funds: mix of stocks, bonds, lower risk. Money market funds: invest in treasury bills and short term debt, safe but low returns. Many Egyptian banks, CIB, Bank Mizr, NBE, etc., offer these. Tana 3. Government bonds and treasury bills issued by the Egyptian government. Safer than stocks with fixed returns, can be accessed through most banks or brokers. Good for stability and predictable income. Certificates of deposit, CDs, high interest savings, still in the bank, but locked for 1 to 3 years with higher interest. Not as strong as stocks for long term growth, but better than leaving money idle in a current account. 5. Personal growth, skills investment. Courses in financial analysis, trading, or a professional certification. This can boost your career and earning power, sometimes the best ROI. Chash suggested split for you. Once you hit your emergency fund goal, 40% stocks, ETFs, equity funds, growth, 30% bonds, treasury bills, fixed income, stability, 20% skills, courses, side projects, future income, 10% cash like instruments for quick opportunities. Would you like me to make a practical 12-month roadmap for how you can move from saving in the bank to gradually building this investment portfolio?